How to read a stock chart for beginners.
Just think, once you learn how to read stock charts, you'll be able to analyze ratios, read balance sheets, income statements. You'll be unstoppable. Well, actually, no. You probably won't be unstoppable. Only the juggernaut is unstoppable. You probably will be a little bit richer, though. Sorry, I get excited about this stuff. This is the stuff that I love to talk about. For those of you new to my channel, in case we haven't met, I'm Aaron, a 20-year corporate accountant and analyst. I'm also a seasoned investor, and I love talking about investing, so I thought I'd share some of my knowledge, and this is the course on how to read a stock chart for beginners. Come on, it'll be fun. Get off the couch and let's learn something. Let's have some fun and make a little money while we do it. That never hurts, does it? Now, what you want to do is you want to go on to a free platform. There are two very popular ones. There's Google Finance, which is pretty good. I occasionally go on to that one. Or there's Yahoo Finance, which I really like. I find the information is just a bit more in depth and I really get a lot more out of it. But you can use either platform. Both are completely free, and I'll give you a walkthrough on exactly the key things that you want to pay attention to when analyzing or deciding on a stock to buy, what all of these numbers mean. Okay, so here we're looking at Apple, ticker symbol AAPL. So we'll start with the very first thing. So previous close, $199.74. What it means. This is the last traded price when markets closed yesterday. Why it matters? Well, it's the baseline. It shows where the stock left off and sets the frame for today's gains and losses. A quick note, if Apple closed yesterday at $199.74, then it opens higher today, and that's a positive gap up. 2, the open. That's what it opened the first trading price of today, which is $206. Why would you watch this? If it opened higher the next day than it previously closed at, this could signal that there were significant events or news articles that you want to pay attention to or be aware of. Maybe something significant happened with the company. Third, the bid of $195.71. What is this? This is the highest price buyers are willing to pay and the size of the shares. The importance is it indicates demand. If the bid jumps up, buyers are eager to buy. Number 4, the ask price of $205. What is this? This is the lowest price that sellers are willing to accept. Why is this useful? It shows supply. A narrower bid spread usually means better liquidity. Number 5, the day's range. You'll see it's 202.80 to 208. What this means is 202.80 is the low and 208 is the high trade price so far today. That's the range that the stock is trading for today. Why this is useful is it helps you see the volatility. So if you see a lot of volatility, maybe there's something going on with that stock. Whereas if the range is lower, it's probably trading and responding to usual market fluctuations. So nothing out of the ordinary that you really have to pay attention to. Don't be so worried about making a mistake with investing. Just get in there and start doing it. The best way to learn is through actually doing it and through action. In case you're new here, like I said, I'm Aaron, a 20-year corporate accountant and analyst living in Western Canada. I talk about personal finance, investing, and investment portfolios. I've been investing for almost 20 years now, and I think it's safe to say I know my stuff. I have the academic background and experience to back up what I'm saying. If this sounds like something you'd be interested in, consider subscribing to my channel. Number 6 is the 52-week range. Now this is 168.15 to 260.10. So again, it's the same thing as the range that we just talked about, but this is the 52-week range and shows the low and the highs over the past year. Why this matters is it positions the current price in context of long-term swings. Number 7 is volume. So you'll see it's 52.8 million. That's the shares that are just being traded today. The significance is high volume confirms strength. Low volume can signal a lack of conviction or weakness with the stock. Number 8 is the average volume. This is typically the daily trading size over the past 50 to 90 days. Why you would compare this is if today's trading volume far exceeds the average, it could signal that something significant is happening with that company and stock. Number 9, and this is one of the more important ones, is the market cap. It's currently sitting at 3.07 trillion. What this means is this is the total value of all the shares outstanding. It equals share price times shares outstanding equals the market cap. Why this matters is it helps classify the company as either a large cap, mid cap, and so forth, and gives you a quick sense of its scale when compared with other companies in that industry. For example, of market cap calculation, Apple's price is 206 times 14.9 billion shares equals 3.07 trillion. For reference, large cap companies are typically over $10 billion. Mid cap range from 2 billion to 10 billion, and small cap are 300 million to 2 billion. They're the smallest, small cap. So now you see this indicator called beta, and it has a 1. A lot of stocks have an indicator of 1 as a standard measurement in the S&P, and it measures the volatility in the market. The higher the beta, the more subject it is to volatility compared with overall market swings. So say a beta of 1.2 means that it will respond more quickly and more volatile to changes in the market, whereas a beta of 0.8 means it's less susceptible to changes in the market and less risky for investors. So say a beta is rated at 1.2. That means it's 20% more susceptible to change and volatility than a beta of 1. So if trades and swings start to happen in the market, it will experience 20% more volatility and trading action and volume than a beta of 0.8 would. Number 11 is the PE ratio. I'm sure you've heard about this in reference to financial ratios. It's one of the more popular financial ratios. Currently it's at 32.48. What this is price to earnings. To calculate it, you take the current price and divide by the earnings per share, trailing 12 months. That equals the price to earnings or PE ratio. Why this matters is it indicates how much investors pay per dollar of earnings. So to calculate it, we take 206 divide by 6.35, that equals an EPS of 32.48. A high PE ratio could indicate that the stock might be overvalued, and a low PE ratio could indicate that a stock is potentially undervalued. However, it's very necessary to compare industries and sectors to industries and sectors, as the PE ratio will vary depending upon what industry you're looking in. Also, many people falsely rely only on the PE ratio. There's actually numerous other factors that you want to look at in determining if a stock is over or undervalued. But it is a great starting point. A higher PE ratio could mean that investors are predicting more growth and activity and returns from that company. And a lower PE ratio could suggest that the company is more established, that you'll see less returns, but it's overall less risky and more stable. So say a company such as Coke will generally have a lower PE ratio than say a company like Tesla or Nvidia. But generally, the more established long-term companies that have been around for 30, 40 years, they'll usually have a lower PE ratio than say some cutting-edge technology company like Nvidia that will have a higher PE ratio. Why? Well, investors are predicting great returns to come eventually, so they're willing to sacrifice and pay more to hold that stock. Number 12 is the EPS, earnings per share, and this is company profit divided by shares outstanding over the last year. So currently it's at 6.3. Number 13 is the earnings date. You'll see it says May 1st, 2025. This is the next scheduled report of quarterly results. So the company announcing how it did every quarter, its performance. Why would you watch this? Earnings often spark big moves up or down based on surprises. Number 14 is the forward dividend and yield. So 1.0 divided by 0.49%. This is annualized dividends per share and yield based on the current share price. Why this is useful? Income investors care about the yield. It shows the cash returns. So to calculate this, take $1 annual dividend, divide by 206, the price, equals 0.49%. Number 15 is the ex-dividend date. So you'll see it says February 10th, 2025. That's the last date to own shares and receive the upcoming dividend. Why this matters is if you buy before this date, you lock in dividends. Otherwise, you miss it. Number 16 is the 1-year target estimate. It's currently sitting at 236.47. What this means is this is the average analyst price target in 12 months. Why you would look at it is it gives a rough consensus of the upside and downside potential. In this comparison, Apple's trailing PE ratio sits at 32.48, while Nvidia's PE ratio is slightly higher at 34.94, reflecting the robust growth trajectories and investor expectations of future earnings expansion. By contrast, consumer stalwarts like Coca-Cola trade at a more modest PE ratio of 29.80 and Procter & Gamble at around 26.39, indicating slower but steadier earnings growth. Dividend yields also underscore these differences. Apple currently yields about 0.49%, Coca-Cola roughly 2.78%, and Procter & Gamble around 2.55%, highlighting how mature companies prioritize returning cash over reinvestment. Apple's modest 0.49% yield comes alongside a strategy of judicious buybacks and selective dividend increases, leaving plenty of cash for R&D and new product launches. Coca-Cola's 2.78% yield and Procter & Gamble's 2.55% yield appeal to income-focused investors who prioritize reliable cash flow and dividend growth over capital appreciation. Hey, if you haven't already, if you're interested in personal finance and investing for beginners, I'd love to have you as a supporter and subscriber of my channel. I come out with new videos every week, stuff you'd actually want to watch. And here I'll go into some of the side tabs that you see that you can play with and see what they do. The Overview tab gives you a quick snapshot of the asset's key information, including the ticker, the current day price, day change, essential metrics like market cap and PE ratio. It also aggregates the most recent news headlines and a brief company description so you can see relevant dates at a glance. The Chart tab displays an interactive graph of price and volume over time for the selected symbol. You can customize the date range from intraday all the way back to an asset's entire trading history. Add technical indicators such as moving averages, RSI, and even overlay multiple tickers for direct company comparison on the same plot. As a beginning investor, you probably won't have to do a lot of this. You just want to ensure that the company is stable, there's no ongoing principle called into question, that the company will keep performing and has steady growth and returns. The Conversation tab hosts like community discussions where investors share insights, rumors, opinions about the stock, where it's going, speculative chat. The Statistics tab dives into quantitative metrics such as valuations, PE, PEG, profitability, ROE, profit margin, trading data, beta, volume statistics, all that statistics if you want to start calculating and looking at financial ratios. Some of it is a good ideal fundamental check. The Historical tab provides a customized table of past prices, so open, high, low, close, volume, plus dividends and stock splits. You can download it in a CSV file for your own analysis if you want. The Profile tab outlines the company's business description, so sector, industry classifications, headquarter locations, where they're at, details on key executives, and company governance. The Financials, this is my section, being an accountant, shows the company's income statements, balance sheets, cash flow statements, and both annual and quarterly basis, letting you assess revenue growth, debt levels, and cash generation trends. It can get pretty technical, but as a beginning investor, you shouldn't have to look too deep into all of this. The Analyst tab provides quarterly forecasts, earnings estimates, revenue projections, growth rates, average price targets, and these are updated quarterly by providers. And then there's the Options tab, and this just displays things like call and put contract, strike price, expiry date, and things for risk aversion and assessment. Hey, if you haven't already, I'd love to have you as a subscriber supporting my channel. Consider subscribing if you want to learn about personal finance and investing from a 20-year Canadian corporate accountant. So 3 of the top things you want to look for as a beginning investor are 1, strong financials and fundamentals. Do they have a healthy profit margin, consistent revenue growth, a healthy balance sheet, and manageable debt. Now, most of this is beyond the scope of this video. However, I will be making a follow-up video, a more in-depth tutorial on how to pick a stock. But two ratios you really want to pay attention to are one, the PE ratio, like I said, and two, the PB ratio, the price to book value ratio. Those are two important ratios. Looking at these two ratios will help more likely ensure that you're not overpaying for the stock. The second thing is competitive advantage and leadership position. You want to ensure that they have recognizable brand technology, that they have some proprietary product or service, and they have a durable moat. What does this mean? Well, their product can't be easily replicated or duplicated by another company. That's very hard for other companies to copy their product or service. And the third thing is a clear market focus and catalyst. So they're continuing to expand operations, they're becoming innovative, and they're not limiting themselves. You're seeing continued growth from that company. I know all of this can seem overwhelming. As you keep doing it and researching it, pretty soon this stuff just comes naturally. You don't have to think too hard about it. But by the way, you could do all of this research and still be wrong, still pick a bad stock. You're more likely to choose a good stock rather than a bad stock that you just pick blindly. So you want to understand what that company really does. Just saying they're an AI company, that's not good enough. Are they producing image and videos that you see everywhere online and competing with hundreds, thousands of other companies? Or are they producing a unique AI chip or some other AI product that is very unique and strategically placed in the market? Now, some people will say, don't look at past performance as that's not indicative of future performance. I don't care. I always look at past performance, right? And you're going to judge if you see a stock going down and all of a sudden it's near the bottom. And well, there's a chance maybe you're picking a stock when it's about to make a comeback, but I really look into those financials. Whereas if you see a stock that's continuing to gradually increase, well, chances are that's probably a better bet. That's what I do. So it's like an employee, right? You wouldn't hire an employee with a horrible track record of 5 years and say, oh, I'm sure that they're probably going to turn it all around, as opposed to an employee with a stellar 10-year track record. Well, my money's on the stellar employee with the proven track record. Now, there are management changes. Did they recently change management? All that, again, beyond the scope of this course. But I always look at a 3 to 5 year trend of past performance to see how the stock did and how it's performed. Another question I want to answer is you probably have, well, Aaron, why wouldn't I just buy stock that have dividends? Like that would be the way to go. Wouldn't I always want stock that's paying me a dividend, have that money in my pocket? Well, yes and no. So if a company pays dividends, well, chances are, like Coke, that company is already established, right? So every quarter, most likely, you'll see a dividend payout as Coke's appreciation for holding that stock. Whereas, say, Apple, you most likely won't get that dividend, or Tesla, or Nvidia. However, you'll see greater returns or stock performance most likely from those tech companies that don't pay dividends as opposed to those that do. Why? Well, because instead of paying a dividend, they reinvest that money back into the company. So you'll most likely see higher growth in that stock when compared with Coke. Coke will still grow and their stock will most likely continue to go up, but more likely Tesla, Nvidia, all those tech industries, well, you see greater stock performance from that because they are reinvesting that money back into the business to grow operations. So in order to start investing, actually start buying stocks, many people are like, well, how do I actually get started? What are the steps? You have to go on and create an online brokerage account. In Canada, there are many great options to choose from. You have Questrade, Wealthsimple, RBC Investing, TD Investing, and many others out there. You go on to a trusted platform that you're familiar with or that you know and trust, and you register, set up your banking information, all of that. The whole process takes usually about 10 minutes. From there, you go on and you start researching stocks. And this is the fun part. You start looking at and comparing performance, ratios, all of that. And you choose what appeals to you and you try to diversify your portfolio. So you pick a variety of stocks in a variety of industries. And I'll give you some key tips for not only beginning investors, but seasoned investors as well, as they adhere to this. First off, diversify. Don't limit yourself to just one sector or industry. Buy a variety of companies in a variety of areas and industries. Number two, look for sustained growth. You're investing for the long term, or at least I hope you are. So look into stocks that will continue to perform over 5, 10, 20 years, because that's where the real gold mine is. Don't look for short-term payoffs. 3, stay informed. Try to keep up to date, at least on some of the news that is happening within the company, with the industry, and so forth, so you're not hit with unexpected surprises. And 4, don't panic and just sell your stock at the first downturn. So if you see the stock suddenly start to drop, don't panic and sell. This is one of the critical mistakes that many investors make. They start to panic, don't know what's going on, and they sell their stock way too early. Sometimes that's justified, but more likely, most often than not, they should continue to hold that stock. Most likely, most stocks continue to appreciate over time, and they'll always experience short-term fluctuations. It's inevitable. It can't be avoided. And the fifth and final tip is use platforms like Google, Yahoo Finance to research and look at stocks and kind of compare company to companies and look at the industry as a whole. So it's fun and informative, and it helps reinforce the decision you made, if you made a good choice with buying that stock. Many people are just afraid to get started right in investing. They're so worried about making a mistake. Do what I did. Like, I didn't know anything like 20, 30 years ago. You just get on and we live in an age where you can look up almost anything instantly, right? With the click of a button. You just go on, type into an AI program or Google, what does this mean? What does this do? What does this chart mean? And you build and build on your knowledge, and you get stronger every time you do it. So like I said, the first thing I would pay attention to as a beginning investor is market capitalization. So ideally, if you choose a larger company, that's more likely a safer bet, right? Than choosing a small startup company, a small venture just starting up. It doesn't know where it's at. If you choose a larger company, most likely they're going to continue to perform well. You want to have a market cap of over, ideally, $10 billion, as this indicates a large cap firm. It's more stable and established. Ideally, you want the PE between 15 and 25 is generally considered reasonable, indicating a balance between stock price and earnings. If you like dividends and you like receiving that quarterly or monthly dividend yield, you ideally want a dividend yield of between 2 and 4%, and this can provide steady income stream for you. Aim for a beta between 0.8 to 1.2 to find stocks with volatility levels close to the overall market, right? Remember how I said the S&P is at 1? So you don't want to deviate too far from that. That could signal that there might be a problem or changes happening with the company. A beta of between 0.8 to 1.2 offers you a balance between risk and return.